Ladies and gents, the stock market's booming. AI stocks are surging thanks to President Trump. Headlines are hyping up a soft landing, but if you're only looking at equities, you're missing the real story because the housing market is quietly doing something completely different. Prices in many US cities are already slipping, as I've talked about over the last few weeks. Not predicted to, not possibly, it's happening right now. And what's even crazier, a lot of people don't even realize it yet. But if you stick with me, I'll explain why the data is misleading, where the cracks are showing up first, and how that might actually create a window of opportunity if you're paying attention. But this isn't about calling a crash. It's about understanding the correction that's already in motion and what happens next. Because while some parts of the market are softening fast, others are strangely resilient. And that imbalance is creating openings, but only if you know where to look, and we'll get into that in a few minutes. First, let's talk about the data everyone's misreading, national price charts. When you zoom out, it might look like prices are flat or even slightly up year over year. But here's the problem with that. Those charts only track homes that actually sold, not the ones that sat on the market, got price cut 4 times, and then were pulled with no buyer. And in slow markets, it's those homes, the ones that didn't sell, that tell the real story. Because what we're seeing in multiple metros right now is that sellers are having to drop prices far below recent comps to get a deal done. That isn't showing up in the averages yet, but it will. And when it does, it's going to change the narrative. And it's already started in certain parts of the South, where rapid construction during boom years collided with affordability ceilings, add in high mortgage rates, and suddenly buyers just backed off. In those markets, listing inventory has quietly ballooned, but you won't hear that in the national headlines just yet. Stick with me, we're just getting into it. Meanwhile, mortgage rates have dipped to the lowest level of the year. That's right, we're talking mid-sixes after spending much of the year hovering above 7%. Why the drop? It wasn't the Fed. They didn't cut rates. What actually moved the needle was weak job data and bond market fear. Investors are starting to get nervous about a recession, and that's pulling yields and mortgage rates down. I explained this in much greater detail in my last video, so go ahead and watch that next. But here's where it gets nuanced. Rates didn't drop because the economy is getting stronger. They dropped because confidence is getting shakier. That's not a long-term recipe for relief. It's more like a short-term window that could close quickly. So the big question is, will buyers move while it's open? We're also seeing another interesting new trend, fewer new listings. Not total inventory, new listings. That means homeowners are hesitating to sell, especially in markets where they're not getting the price they want. This creates a strange dynamic. Inventory is technically rising, but it's mostly stale listings. Meanwhile, demand is muted but not gone. And this kind of standoff between buyers and sellers can stretch for months before a market starts moving again. And yet, demand is slightly up compared to last year. Not by much, but enough to prevent a free fall. That's why we're seeing slow corrections instead of sharp collapses in prices. But let's not confuse that with strength. It's more like controlled weakness. Prices are being dragged down in pockets, not because everyone's panicking, but because some sellers have to meet the market. This is where things start to diverge. Some sellers are choosing to sit tight, but others, like investors, builders, or folks relocating, have timelines. They're motivated. They're pricing aggressively. And those are the deals that reveal where values are actually heading. But remember, the data always lags. If you're only watching the averages, you're already late. And that brings me to the opportunity I teased earlier. If you're disciplined, you're watching the right signals, not just rates, but inventory shifts, days on the market, and seller behavior, you might find windows to buy below replacement cost in areas with long-term upside. But it won't show up in your Zillow feed. So to help with that, we put together the Deal Watch newsletter. Every week, we surface early indicators in local markets, price anomalies, off-market movement, under-the-radar price cuts before they make it into the national narrative. It's not about hype. It's about understanding where demand and supply are actually shifting. You can find the link in the description if you're curious. It's totally free, no obligation. So here's the big takeaway. This isn't 2008. Credit quality is still solid. Delinquencies are flat. But this also isn't 2021. Buyers are cautious, sellers are backing off. And in between, a small but growing number of deals that are actually penciling out. But only if you're paying attention. Will prices fall more? Maybe. But the best opportunities never come when the headlines are screaming panic. They show up in moments like this when the narrative is quiet and the data is lagging. And most people are still waiting for permission to act. If you want to stay ahead of those shifts, subscribe to this channel and keep an eye on the Deal Watch. Will help you cut through the noise, spot the signals early, and navigate this weird lopsided market with clarity. Because the crash, it's not coming, it's already started. The only question is, who sees it first? See you on the next one. Bye.